Imagine this. One morning you open your CRA mail and see a tax bill based on numbers you've never reported. You call CRA and they say, we use subsection 152(7) of the Income Tax Act. We rebuilt your income because your return was not reliable. Hi, I'm Amandeep Singh from Cloudivers CPAs Inc. in Burnaby, where we guide business owners through Canada's tax system like Google Maps for income tax, helping you avoid the wrong turns before they get costly. Okay, let's get back to the case. Now, let's unpack what subsection 152(7) really means and why timing matters more than most people realize. Jonathan Bousfield learned this the hard way. He ran a small taxi business in Regina. His drivers kept white envelopes with daily fares and fuel, but many were missing or incomplete. CRA said, we can't trust these, and used subsection 152(7) to make what's called an alternative assessment, a legal estimate of income that replaces the taxpayer's numbers. Under that rule, CRA does not have to prove your books are bad. They can estimate based on patterns, that is, bank deposits, industry averages, or other data, and issue an assessment that's presumed correct. Now, in Jonathan's case, CRA tried 4 different methods to rebuild his revenue: average daily income, average fare per trip, an industry ratio of cash to credit, and one using his own envelopes. They averaged everything and said, here's what you owe. Jonathan, of course, disagreed and went to court, and this is where the judge's reasoning matters. Justice David Graham carefully examined each formula. He found CRA's first methods too generic. They leaned on city averages, never proven in evidence. He found the industry cash to credit ratio distorted by Jonathan's unique daytime child trip contracts that were fully non-cash. Jonathan's own method also fell short, missing schedules, missing documents, and gaps in how fares were recorded. So, the judge created a custom model based on the real evidence: actual dispatch records for non-cash fares, a cash to non-cash ratio drawn from the envelopes that still existed, GST adjusted correctly since some trips included it and others did not, and the 50-50 split with drivers. That reconstruction produced a fairer result. Income dropped by roughly $45,000 to $50,000 per year, and penalties for 2 years were completely deleted. For the final year, penalties stayed because a quarter of the income remained unreported. The key takeaway: subsection 152(7) gives CRA real power when your books don't tell the full story. And once that assessment is issued, the clock starts ticking. You have 90 days to file notice of objection. If you miss that deadline, the assessment becomes binding, even if it's completely wrong. So filing your correct corporate return later does not automatically erase CRA's estimate. After 90 days, CRA does not have to reopen it unless they chose to. And after a year, even that option disappears. That's why I tell every business owner, when a 152(7) or best guess assessment arrives, treat it like a fire alarm, not a ladder. Act fast. File the objection right away. Then gather your proof, invoices, bank records, and statements that show your real income. At Cloudivers CPAs in Burnaby, we focus on keeping your tax filing solid and defensible, so CRA never needs to guess. And when a 152(7) assessment does appear somehow, we help you move quickly, filing the objection on time and rebuilding your financial story with evidence CRA can accept. Because once that 90-day window closes, CRA's numbers become your numbers, and that point, and at that point, the only map left is the one they drew for you. I'm Amandeep from Cloud River CPAs in Burnaby. If you've received an arbitrary or 152.7 assessment, or even a notice that one is coming, reach out right away. The faster you act, the easier it is to replace CRA's estimate with the truth your records can prove. Thanks for watching, and I'll see you in my next video. Until then, bye.